You need to see what just happened in the gold market, because what I'm about to show you defies everything we thought we knew about how markets work. Let me paint you a picture. It's December 2025. Gold just hit $2,176 per ounce. That's not a typo. $2,876. And here's what makes this absolutely impossible. It happened while the Federal Reserve is holding rates steady, while the dollar has been relatively strong, and while every traditional analyst said gold should be consolidating. That's not supposed to happen. It's like watching water flow uphill. And if you think that's just a weird market anomaly, you're missing the biggest wealth transfer that's happening right now, in real time, while most people are completely asleep at the wheel. Because what's driving this isn't retail investors panic buying. It isn't even the big hedge funds making speculative bets. What's happening right now is that central banks around the world are buying gold at a pace we've never seen before in modern history. And they're doing it for a reason that should terrify anyone holding significant wealth in dollars. Let me show you the numbers because this is where it gets really interesting. In 2024, central banks purchased over 1,037 metric tons of gold. That's the third consecutive year of purchases exceeding 1,000 tons. Think about that for a second. 3 years in a row of record-breaking buying. This isn't a trend. This is a fundamental shift in how the world's most powerful financial institutions view money itself. The People's Bank of China has been adding to reserves month after month. Not occasionally. Not when prices dip. Every single month like clockwork. The National Bank of Poland announced they're targeting 20% of reserves in gold. 20%. That's not a hedge. That's a statement. Turkey's central bank has been one of the most aggressive buyers, accumulating at a pace that would have been unthinkable a decade ago. India's Reserve Bank continues stacking. Even smaller nations you've never heard of are stockpiling gold like their economic survival depends on it. And maybe it does. Because here's what's really happening beneath the surface. These central banks aren't buying gold because they think it's going to $3,000 or $4,000 or even $5,000 an ounce. They're buying gold because they're preparing for something much bigger. They're preparing for a world where the dollar isn't the global reserve currency anymore. Think about that for a second. The entire global financial system has been built on dollar dominance since 1944. The Bretton Woods Agreement made the dollar the world's reserve currency, backed by gold. Then in 1971, Nixon closed the gold window, and we've been running on pure faith ever since. Faith that the U.S. government won't print too much. Faith that the dollar will hold its value. Faith that America will remain the dominant economic superpower forever. But faith is a fragile thing, and right now, that faith is cracking in ways that most people don't see yet. You've probably heard about BRICS, Brazil, Russia, India, China, South Africa. But what you might not know is that BRICS just expanded massively. They added Saudi Arabia, the UAE, Egypt, Ethiopia, and Iran. That's not just a trading bloc anymore. That's 45% of the global population. That's countries controlling a massive portion of the world's oil, natural gas, rare earth minerals, and critical resources. And they're all talking about one thing, settling trade in currencies other than the dollar. China and Saudi Arabia are actively discussing yuan-based oil transactions. Russia and India are trading in rubles and rupees. The UAE is exploring dirham settlements for energy deals. This isn't theoretical anymore. This is happening right now, in real transactions, in real markets. And every single one of these countries is buying gold, because gold is the only asset that isn't someone else's liability. It's not a promise. It's not backed by a government's word or a central bank's balance sheet. It's real, physical wealth that's been recognized for 5,000 years across every civilization, every empire, every economic system. Now let me show you something that should make your blood run cold if you're sitting on significant dollar-denominated assets. The U.S. national debt just crossed $36 trillion. Trillion with a T. That's $36,000. And it's growing by roughly $1 trillion every 100 days. Let that sink in. Every 100 days we add another $1 trillion to the national debt. That's $10 billion per day. $416 million per hour. $7 million per minute. While you've been listening to me talk, the national debt has increased by over $50 million. And here's the kicker. There's no plan to stop it. Both political parties are spending like there's no tomorrow. Defense spending, entitlements, interest on the debt itself, it's a runaway train. And the only way out is to either default, which would destroy the dollar's reserve status overnight and trigger a global financial crisis, or to inflate the debt away by printing more money. Guess which option they're going to choose? This is why gold is doing the impossible. It's not responding to traditional correlations anymore because the game has fundamentally changed. We're not in a normal economic cycle where you can predict gold's movement based on interest rates or the dollar index. We're in the endgame of a 50-year experiment in fiat currency, and the smart money knows it. Let me tell you a story about what happened in 1971, because history doesn't repeat, but it sure as hell rhymes. When Nixon closed the gold window on August 15, 1971, gold was $35 an ounce. People thought the sky was falling. Economists predicted chaos. But you know what happened over the next 9 years? Gold went from $35 to $850. That's a 2,400% increase. But here's what's different now, and this is critical. In 1971, the U.S. was still a creditor nation. We had manufacturing, we had savings, we had a trade surplus. We were the world's largest producer of oil. Our debt to GDP ratio was manageable. We had room to maneuver. Today, we're the world's largest debtor nation. We've offshored most of our manufacturing. Our personal savings rate is abysmal. We run massive trade deficits year after year. Our debt to GDP ratio is over 120%. We import most of our energy. And we're printing money at a rate that would have been unthinkable in 1971. In other words, we're in a much weaker position than we were in 1971. And gold still went up 24 times back then. Now, I'm not saying gold is going to $60,000 an ounce, although some very smart people with impressive track records are making exactly that case. What I'm saying is that we're in uncharted territory, and the traditional rules don't apply anymore. The correlations that worked for 50 years are breaking down in real time. Look at what's happening in the physical gold market right now. This is where you see the real story. Premiums on physical gold coins and bars are elevated across the board. Delivery times are stretching out. The U.S. Mint has had to ration sales of American Gold Eagles multiple times in 2024 and into 2025. In Asia, premiums over spot price are even higher. People in China and India are paying $50, $100, sometimes $150 over spot just to get their hands on physical metal. Why? Because there's a growing recognition that paper gold and physical gold are two completely different things. You can create infinite paper gold contracts on the COMEX. You can trade gold ETFs that may or may not be fully backed by physical metal, but you can't create more physical gold. There's only so much of it in the world, and it takes 7 to 15 years to bring new mines into production. And here's where it gets really interesting. The COMEX, the major exchange where gold futures are traded in New York, operates on a fractional reserve system. For every ounce of physical gold sitting in their vaults, there are roughly 100 ounces of paper claims against it. That works fine as long as nobody asks for physical delivery. But what happens when they do? We got a preview of this in March 2020. During the COVID panic, the spread between paper gold futures and physical gold blew out to over $100 an ounce. People couldn't get physical metal. Dealers were completely sold out. Premiums went through the roof, and that was just a temporary disruption caused by logistics and panic buying. What happens when central banks, sovereign wealth funds, pension funds, and high net worth individuals all decide they want physical gold at the same time? What happens when the paper market breaks because there's not enough physical metal to satisfy delivery demands? That's not a conspiracy theory. That's a mathematical certainty if current trends continue. And the central banks know it. That's why they're not buying gold ETFs. They're not buying futures contracts or certificates. They're buying physical bars, 400-ounce London good delivery bars, and storing them in their own vaults under their own control. Quick aside here, because this is relevant if you're thinking about your own financial security. If you're sitting on $100,000 or more in retirement accounts, you might want to understand how gold IRAs work. I put together a free guide that covers how to get physical gold into your retirement account without triggering tax penalties or early withdrawal issues. It's in the description below, no pressure, but it's worth understanding your options given what's happening in the broader market. Anyway, back to what's driving this price action, because there's another layer most people are completely missing. Industrial demand for gold is surging, not jewelry, not investment. Industrial use in technology and manufacturing. Gold is a critical component in electronics because it doesn't corrode and it's the best conductor. It's used in aerospace for the same reasons. Medical devices rely on gold for biocompatibility, and increasingly, green energy technology requires gold. Solar panels use gold in their circuitry. Electric vehicles use more gold than traditional internal combustion cars because of all the electronics and sensors. 5G infrastructure requires gold for signal transmission. And as we transition to a more electrified, connected, automated world, industrial demand is only going to increase. But here's the problem that nobody's talking about. Gold mine production peaked in 2018. We're not finding major new deposits. The easy gold, the high-grade deposits near the surface, has been mined. What's left is deeper, lower grade, more expensive to extract, and often in politically unstable regions. And it takes 10 to 15 years to bring a new mine from discovery to production, assuming you can get permits and financing. So you have increasing industrial demand that's structural and growing, record central bank buying that shows no signs of slowing, growing investment demand from individuals who see the writing on the wall, and declining mine supply. That's not a recipe for lower prices. That's a setup for a supply squeeze that could make what we've seen so far look like a warm-up. Now let me show you something that's happening right now in the derivatives market, because this is where the real action is for people who understand market mechanics. The commercial traders, the big banks and institutions that actually deal in physical gold and use futures for hedging, have been reducing their short positions. These are the smart money players who handle physical metal, who understand supply and demand at a granular level. And they're covering shorts, which means they expect higher prices. At the same time, the managed money, the hedge funds and speculators who trade based on momentum and technical analysis are not as heavily long as you'd expect given the price action. In previous gold bull markets, by the time we hit all-time highs, the speculators were massively long, over-leveraged, vulnerable to a correction. But right now, they're relatively cautious. Positioning is moderate. You know what that tells me? This move isn't driven by speculation and leverage. It's driven by fundamental demand from entities that want to own physical gold. And when the speculators finally pile in, when the momentum traders and the retail crowd wake up to what's happening and start chasing, that's when this thing could really take off. Let me give you another historical parallel, because this is important for understanding what might come next. In 2008, during the financial crisis, gold initially sold off hard. It dropped from $1,000 to $700 in a matter of months. People needed cash to meet margin calls, so they sold everything, including gold. And everyone said the gold bull market was over, that gold had failed as a safe haven. But you know what happened next? Gold went from $700 in late 2008 to $1,900 in September 2011. It nearly tripled in less than 3 years. Because once the initial panic subsided, people realized that the response to the crisis, printing trillions of dollars and bailing out banks with taxpayer money, was going to destroy the currency's purchasing power. And they were right. The dollar has lost over 30% of its purchasing power since 2008. If you held cash in a savings account, you got crushed by inflation. If you held gold, you not only preserved your wealth, you increased it substantially. Now, fast forward to today. We just went through COVID, where we printed more money in 2 years than in the previous 2 centuries combined. We've got inflation that peaked at 9% officially, though anyone who buys groceries or pays rent knows the real number was much higher. And even though headline inflation has come down, prices haven't. Your grocery bill is still 30% higher than it was 3 years ago. Your rent, your insurance, your energy costs, everything is more expensive and staying expensive. And the government solution? Print more money, spend more, borrow more. They're not fixing the underlying problem. They're making it worse with every stimulus package, every bailout, every new spending program. This is why gold is breaking traditional correlations. It's not responding to interest rates or the dollar index anymore because those metrics don't matter when the entire system is built on a foundation of debt that can mathematically never be repaid. Think about it this way. If you personally owed $36 trillion and your annual income was $4.5 trillion, but your expenses were $6.5 trillion, what would happen? You'd be bankrupt. You'd have to default on your debts or find a way to make your creditors accept less than they're owed. That's where the U.S. government is right now. And everyone knows it. The central banks know it. The sovereign wealth funds know it. The billionaires know it. That's why they're buying gold. They're not speculating on a trade. They're protecting themselves from what's coming. But here's what really keeps me up at night. And this is something most people don't understand. The derivatives market. There's over $600 trillion in derivatives outstanding globally. That's not a typo. 600 trillion. And a huge portion of that is tied to interest rates and currencies. What happens when currencies start to break down? What happens when the dollar loses its reserve status and all those derivatives, all those bets and hedges and swaps start to unwind? We're talking about a potential financial crisis that would make 2008 look like a minor correction, like a speed bump. And in that scenario, what's going to hold value? Not stocks, because they're priced in dollars and their earnings are in dollars. Not bonds, because they're promises to pay you back in devalued currency. Not real estate, because it's illiquid and property taxes are priced in dollars, and if you need to sell in a crisis, good luck finding a buyer. Gold. Physical gold. That's what's going to hold value, because it's not dependent on any government, any bank, any promise, any counterparty. It just is. It exists. It has value, because humans have agreed it has value for 5,000 years. Now, I know what some of you are thinking, but gold doesn't pay interest. It doesn't generate cash flow. It doesn't produce anything. It just sits there. And you're absolutely right. Gold doesn't pay interest or dividends. But you know what? Neither does cash in a world where inflation is running higher than interest rates. At least gold maintains its purchasing power over time. At least gold can't be printed into oblivion by a central bank trying to solve a debt crisis. Let me give you a concrete example that really drives this home. In 1971, the average house in America cost about $25,000. Gold was $35 an ounce. So a house cost roughly 714 ounces of gold. Today, the average house costs about $420,000. Gold is around $2,800 an ounce. So a house costs roughly 150 ounces of gold. In other words, if you held gold instead of dollars over the last 50 years, houses got massively cheaper. A lot cheaper. That's the power of holding real money in a world of currency debasement. That's what happens when you own an asset that can't be inflated away. And we're about to see an acceleration of that trend, because the debt spiral we're in doesn't have a happy ending. It ends with either default, which is politically impossible, or hyperinflation, which is politically inevitable. And in either scenario, gold wins. Look at what's happening in other countries right now. Turkey has seen its currency collapse. Inflation hit 85%. And you know what Turkish citizens did? They bought gold. Gold shops on every corner in Istanbul. People converting their lira into gold as fast as they can because they know their currency is dying in real time. Argentina, same story. The peso has lost over 90% of its value. Venezuela, same story. The bolivar is worthless. Lebanon, same story. The pound collapsed. Every time a currency collapses, people flee to gold. It's happened throughout history, from the Roman Empire to Weimar Germany to Zimbabwe to Venezuela. And it's happening right now in multiple countries around the world. And if you think it can't happen here, you're not paying attention. We have the same fundamentals as those countries, just on a larger scale and with more sophisticated propaganda, massive debt, political dysfunction, money printing, declining trust in institutions, growing wealth inequality. The only difference is we're the reserve currency, so we've been able to get away with it longer. We've been able to export our inflation to the rest of the world. But that's changing. And when the dollar loses its reserve status, when foreign central banks stop buying our debt, when the world moves to a multipolar currency system with multiple reserve currencies or a basket of currencies backed by commodities, that's when the chickens come home to roost. That's when Americans will feel what it's like to have a currency that's not accepted everywhere, that's not trusted, that's losing value. Here's another thing that's not being talked about enough. The younger generation, millennials and Gen Z, they don't trust the traditional financial system. And why should they? They saw their parents get crushed in 2008. They watched the banks get bailed out while regular people lost their homes. They've seen wealth inequality explode to levels not seen since the Gilded Age. They've watched the cost of housing become completely unaffordable in most major cities. They've seen their purchasing power erode year after year while being told inflation is under control. And they're looking for alternatives. Some of them are buying Bitcoin and crypto, which is a whole other conversation. But a growing number are also buying gold and silver. They're recognizing that precious metals are the original money, the money that survived every empire, every currency collapse, every financial crisis in human history. And as that generational wealth transfer happens over the next 20 years, as trillions of dollars move from boomers to younger generations through inheritance, where do you think some of that money is going to go? Into assets that can't be debased by central banks, into assets that have proven themselves over millennia. Now let's talk about what could accelerate this trend even further, because there are several potential catalysts on the horizon. A major geopolitical event, a war that disrupts global trade, a pandemic worse than COVID, a cyber attack on the financial system that takes down payment networks, a debt crisis in a major economy like Japan or Italy. Any of these could trigger a flight to safety that would send gold parabolic. And the scary thing is, we're closer to several of these scenarios than most people realize. Tensions with China over Taiwan are at their highest level in decades. The ongoing war in Ukraine shows no signs of ending. Instability in the Middle East continues to simmer. Cyber attacks on critical infrastructure are increasing in frequency and sophistication. Japan's debt-to-GDP ratio is over 250%, the highest in the developed world. Italy's banking system is fragile. These aren't distant possibilities. These are current realities that could explode at any moment. And in every one of these scenarios, gold is the safe haven. It's the asset that performs when everything else is falling apart. It's what people run to when they're scared, when they don't trust governments or banks or paper promises. But here's what you need to understand, and this is critical. By the time the crisis hits, it's too late. By the time everyone realizes they need gold, the price will have already moved substantially higher. The premiums will be through the roof. The dealers will be sold out. You'll be competing with millions of other people trying to get their hands on physical metal, and you'll be paying whatever price the market demands. The time to position yourself is before the crisis, not during it. And if you look at what the central banks are doing, if you look at what the smart money is doing, if you look at what the billionaires and sovereign wealth funds are doing, they're positioning right now. They're not waiting for confirmation. They're not waiting for the mainstream media to tell them it's okay. They're acting on what they see coming. I want to show you one more thing, because this really drives the point home about where we are in this cycle. The gold to silver ratio. Historically, this ratio has averaged around 15 to 1 over the very long term, meaning 15 ounces of silver equal 1 ounce of gold in value. Today, that ratio is around 90 to 1. What does that tell you? Either gold is massively overvalued relative to silver, or silver is massively undervalued relative to gold. And given everything we've talked about, given the industrial demand for silver, which is even more critical than gold for technology, given the supply constraints in silver mining, I'd argue silver is the one that's dramatically mispriced. But that's a whole other conversation about the silver market. The point is, the precious metals market is sending signals that something big is coming. The ratios are out of historical norms. The correlations are breaking down. The physical market is tight. The premiums are elevated, and the central banks are accumulating at record pace. All of this is happening while most people are completely oblivious. They're watching their 401ks, thinking everything is fine because the stock market is near all-time highs, but the stock market is priced in dollars. And if the dollar loses 50% of its value over the next 5 years, which is entirely possible given current monetary policy, your stocks might be up in nominal terms, but you're still losing purchasing power. You're still getting poorer in real terms. This is the wealth transfer I'm talking about. Wealth is moving from people who hold paper assets denominated in depreciating currencies to people who hold hard assets that maintain their value over time, from people who trust the system to people who understand the system is broken. And gold is the ultimate hard asset. It's been money for 5,000 years. It's survived the fall of Rome, the collapse of the British Empire, 2 world wars, the Great Depression, the stagflation of the 1970s, the dot-com bubble, the housing crisis, and every financial crisis in between. It's going to survive whatever comes next. So when I say gold just did something impossible, I'm not talking about a short-term price move that will reverse next week. I'm talking about gold breaking free from the traditional correlations and relationships that have defined it for decades. I'm talking about gold reasserting itself as real money in a world drowning in fake money, in a world where central banks have printed themselves into a corner with no way out. And if you understand what's happening, if you can see the bigger picture beyond the daily noise and the mainstream narratives, this is the opportunity of a lifetime. Not to get rich quick with some speculative trade, but to preserve your wealth and protect your family's financial future in a world that's becoming increasingly unstable and unpredictable. The central banks see it. They're buying over 1,000 tons a year. The billionaires see it. They're allocating significant portions of their portfolios to physical gold. The sovereign wealth funds see it. They're diversifying out of dollars and into hard assets. The question is, do you see it? And more importantly, are you going to do something about it before it's too late? Because what's happening right now in the gold market isn't impossible. It's inevitable. It's the natural consequence of decades of monetary mismanagement, debt accumulation, currency debasement, and the erosion of trust in fiat money. And it's only going to accelerate from here as more people wake up to the reality of our situation. The gold price just did something impossible. It broke the rules. It defied the correlations. It showed us that the old playbook doesn't work anymore. And that's not a bug in the system. That's a feature. That's gold telling us that the game has fundamentally changed, and we better pay attention before we get left behind holding worthless paper while the smart money holds real wealth.